investors, welcome to Model Book Stock Review, where I'll be taking you back in time through a series of historic trades made by IBD founder and author of How to Make Money in Stocks, William O'Neill. O'Neill himself believed that it was very important for investors to study precedents, to understand what winning breakouts of the past look like. At one point, he penned a print column called America's Greatest Opportunities that detailed many of his greatest trades, the fundamental stories behind them, and, of course, the technical action. As IBD investors know, it's that powerful combination of technicals and fundamentals that's key to finding the next big winners in the market. So for today's trade, we're traveling back to early 2009 to study O'Neill's successful trade in Netflix stock. We're looking at a breakout that yielded a return of over 750% in a little over 2 years, when the stock initially took off in the early stages of the company's rise to success. As for the fundamental side of the trade, the leisure sector was an area of the market that O'Neill would return to many times throughout the years. IBD's head of market research and longtime assistant to O'Neill, Justin Nielsen, told me about his trading approach.
One of the things that Bill really wanted people to understand is that there were certain sectors that came up over and over in these best performing stocks. And one of those was leisure. Throughout the decades of his experience in the stock market, he saw multiple examples of these leisure stocks doing very well. One of the first ones actually was Brunswick. Brunswick was a big move in the 60s. You've had leisure like Disney, Walt Disney Company, not only the movies, but the theme parks. That leisure sector was something that Bill paid particular attention to.
Historically, O'Neill saw this as a theme that kept happening over and over in the market. The leisure and entertainment industries would have major innovation every couple of years, and this time it was Netflix's turn. For this trade, O'Neill started with the premise that everyone loves movies, and of course, Netflix was the first mover in bringing those movies to your home. This was back when it was just starting to put Blockbuster out of business. People were starting to enjoy the convenience of having a red envelope show up in the mail straight to their house. As for the technical action of this trade, Nielsen recalled how this opportunity came at just the perfect time after the 2008 financial crisis caused the market to crater.
Now, in 2007, it was interesting that Netflix had introduced a streaming service, and remember, they were really basically DVDs at that time, mailing the DVDs. They introduced streaming as a new service, and it was something that they were offering for free at first because they didn't have a lot of offerings. And the timing might have been a little bit off, because what do we have right around the corner? The great financial crisis, the Great Recession, global recession everywhere after the subprime housing bubble popped, and it really kind of put our financial system on the brink. But one of the interesting things is when you look at, no matter how bad things get, there are always certain stocks that are resisting the downtrend.
O'Neill knew that while things looked bad at the moment, when things began to turn around, the power of the next uptrend would possibly be huge.
The financial crisis was probably number 3 in history for America in terms of how bad it was. 57% off the peak for the S&P 500, and Netflix, as a lot of stocks were doing, came down along with it. But what was interesting is how it came out of it. The stocks that were showing relative strength were the ones that were deserving of the most attention. You can see here in January of 2009, remember the follow-through day that we were working off of was March of 2009. But in January of 2009, Netflix came out of a cup with handle base.
At the time, the major indexes were still going down. They didn't bottom until March of 2009. But Netflix stock, by contrast, was already moving back towards highs. You can see this contrast by looking at the relative strength line on the Netflix chart. It was already hitting new high ground at the time of the breakout, before the stock even hit a new all-time price high. This was O'Neill's first clue that technically this chart was one to pay attention to. The relative strength was giving us a clue that this may be one of the next stocks to lead the indexes back to higher ground. So the stock broke out of a cup with handle on January 30th and moved higher until...
One of the first things it does after breaking out of this cup with handle is pull back. Now, the market is still in trouble. It's making lows, but Netflix isn't. It's not making lows. It's just pulling back to the buy point. And Bill O'Neill wrote in a lot of his books how 40 to 50% of stocks will break out of a base and then come right back to their buy point. So this was very normal action for Netflix to do.
Eventually, Netflix traded higher, but it wasn't long until another notable thing happened in the stock's move.
At the end of '09, Netflix went through a correction. It formed another base. And one of the things that Bill would mark up a lot of times is when something came up straight up from the bottom. He would put the acronym SUFB there, straight up from the bottom, because it was something that a lot of times he didn't trust at first. But there were those cases where if you paused and you didn't give up much ground, then he would see that as a positive.
He pointed out, too, that you could have taken the opportunity to add on this earnings gap here. From there, it really didn't give investors a reason to sell as the stock rose multiple weeks up in a row, showing a lot of power. Then, later on in 2010, Netflix corrected once again in the form of a double bottom base, giving investors another opportunity to buy.
Now, let's fast forward to this double bottom that we had in 2010. In 2010, the summer was really kind of in the doldrums, but on September 1st, we had a follow through day. I remember this very clearly. I was buying Chipotle Mexican Grill, as were a lot of folks around the office. But Netflix was another one that came out right at that time. And it zoomed up. And here again, we get that pullback. It pulls back right to the top of that double bottom base, and then it takes off. So you have to be very aware of when those follow through days happen, when those turns in the market happen, and you have to be ready with a bunch of lists of stocks that are potentially ready to buy. And the ones that you want to start with are those that have the best relative strength, because Netflix in this case, again, was one of those that had the best relative strength. And it had a discernible pattern, this double bottom pattern that you can see repeat over and over as you study historical charts. So that was another benefit here and another chance to get into the stock after that correction in 2010.
As O'Neill noted on the chart, the final sell signal for this Netflix trade came when shares sold off 2 weeks in a row on above average volume.
Now, here's something that's a little bit more esoteric. You don't see this sell signal very often, and we noticed that there were a few times where he would point out when a stock had had a long run and it had gotten really extended, when it came down to the 2-week moving average line in a very sharp fashion and then bounced right back up into new highs. But the base was too short to be a real base. In this case, you see it was 2 weeks down and then 2 weeks back up. So he says 4 weeks, that's not long enough to be a base. Something might be fishy here. And so even though it did break out into new highs, this was a way in which he could do some offensive selling. Just like the climax top is one of those ways in which you might sell into the strength, this was an opportunity to maybe take some off. And then especially when he saw the downside reversal the next week, when it goes into new high ground, then closes at the lows of the range, plus volume picked up from the week before and was above average, that was kind of a signal to him, hey, this move might be over.
O'Neill spent a lot of time on these charts, analyzing them, sometimes week by week even, in order to really understand what was happening with the supply and demand of the stock. But he made sure to never neglect what was going on with the fundamentals in the stock as well. In the article he wrote on this trade, he talks about how the 4 years of earnings per share in the company leading up to the trade were very strong, and how the 2008 cash flow for the company at $5.67 per share compared to the earnings per share was strong. Also, O'Neill noted how the return on equity at the time was at 23%, another strong metric boosting the company. So, with the combination of strong fundamental and technical action in 2009, it was clear that this was a stock worth investing in. Many people will have lived through these periods and remember these famous leisure and entertainment companies, making their mark on culture and exploding onto the scene in various ways. Many of us will even be users of these products and services, but few will stop to think about looking further into the fundamentals and technicals of these stocks to see if they're truly worth investing in. The more you learn the facts of past innovative leaders, the more you'll be able to recognize the next crop of winners. There will always be another Netflix, another Apple. So if you want to succeed, don't give up looking both forwards and backwards in time.